Well, howdy there, folks. Welcome in this three-piece here today. 3 videos for me to react to. First one up here is from about an hour ago. There will be a year-end rally, says a Hightower Stephanie Link. We'll hear what she has to say in regards to where this market's headed. Next video up here, companies laying off employees is a risk facing 2024, says this gentleman from JP Morgan. So looking forward to getting into that one. I think it's an important subject. And then last one up here. Since it's Halloween, scariest charts in the financial markets right now that everybody should be paying attention to. So I thought we'd go through that one on Bloomberg from a few hours ago. That should be a fun one. So appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed. Also, if you haven't followed me on Twitch yet, make sure you do that. That's going to be a pinned comment down there. I live stream Monday through Thursday from about 12 o'clock Pacific time to about 1:30, 2 o'clock for basically the earnings that come out after the bell, as well as the last hour of trading. Today we will be reacting to AMD earnings live on there. Tomorrow's PayPal earnings live on there, along with Elf on a Shelf and Etsy. And then Thursday, big old dog, Apple. Plus we'll be reacting to, obviously, Palantir's earnings, Shopify earnings on Twitch as well. So make sure you guys tune in for that. That will be pinned comment down there. Alrighty, guys, let's get into this.
Straight months of declines, been a bit of a rough stretch. I know that most want to know if there's still a chance for a year-end rally. November is the best month of the year traditionally, December 2nd, so seasonality is on our side.
Yeah.
And I see you have a new buy, and it's AMD. And that company reports today in OT, but why is AMD part of the Josh Brown portfolio now?
So AMD is a stock that's been on my radar for a long time. I had been in and out of it before, long time ago. AMD, I think, is at a really interesting moment in the company's history. Tonight, they'll report earnings. The earnings, of course, are always important. But what's more important than the numbers themselves is what Lisa Su has to say about the launch of the new AI chip. So, look, this is a market that Nvidia basically owns. And the H100 chip is what turned Nvidia into a $1 trillion company. And they have a huge lead over everyone, and no one should think that I'm saying otherwise. But what I would say is, if you look at the history of technology, it is highly unlikely that any one company maintains 90 to 100% market share forever. AMD is the chip maker that has the best shot to capture 25, maybe 30% of this market over the next 5 years. And when I say this market, understand something. The market for AI chips could be literally $150 billion if you listen to what Intel says, what Qualcomm says, not just AMD's opinion. So I think that they have a shot.
Okay.
Tonight's a very...
So definitely enjoying what he's saying here, but let's be very clear. He's doing something very interesting. Very interesting. What is he doing? He's buying the stock right before earnings come out, right? Which means he's more scared of this stock going up substantially on earnings, right? Now for AMD, it has good news and bad news. Bad news is this company shouldn't do much in this quarter. The growth should be very small. And if they do miss, it's kind of going to be an embarrassing miss because there's like no expectations. I mean, if you look at the expectations for AMD as far as the EPS growth in their revenue growth year over year, it's like minimal to nothing, okay? So if they miss, it's really going to be embarrassing. On the flip side, since they don't have any big expectations, I mean, you know, sometimes people look at that and they say this is an easy beat situation. And if you beat nicely, maybe your stock goes up 5, 10, 15%. In this market, sometimes those don't even go up. But clearly he's afraid that this stock might spike on earnings, or he wouldn't have bought it right before earnings, right?
They're going to talk about the launch, which happens this quarter. There are 2 types of chips for AI. This is very important. I'll finish with this. 2 types of chips for AI. Training. Nvidia has 90% of the market for training. That's how they teach these systems how to operate. The other market, arguably the more important market longer term, is inference. AMD's architecture is specifically geared toward capturing meaningful share in inference. Inference is like when you go on a large language model, you post a query. That's how it responds on an ongoing basis. So I think AMD is walking through the door of becoming a serious AI player. The stock is down from 158 here in the mid-90s. I have a small position. We'll see what happens if I'm able to add to it. But I wanted to make sure I was in before they came out and said anything that could meaningfully move the stock.
Steph, I mean, it's been dicey lately a bit for the SMH and for the chips. You know, Nvidia is barely above $400. It's the most loved, you could argue, of all.
By the way, you know, it shouldn't come as a surprise if AMD does say anything positive about AI chips in 2024. Everybody's pretty much come to that expectation now on Wall Street that AMD is going to start to see nice AI revenues pouring in 2024. So do keep that in mind.
Names, even though I know it's not the most loved for you, that's where Broadcom and comes in, some of the others, obviously. But Jonathan Krinsky today says in a note, come at the king, you best not miss. Okay, he's talking about Nvidia breaking support and suggests at least 10% more downside is ahead. Now, I know because it's not yours, you may not have a specific opinion on Nvidia, but the space itself can't afford, I'm saying, to have an AMD miss today and an Nvidia break down another 10%.
Well,
because a lot of other names are going to go down with it if it does.
Of course, and that's where your opportunity is going to be. One thing that we've heard from a lot of technology companies is that the PC market is actually...
Whoa, look at this. Holy smokes, this is no joke. As you guys see this in front of you right now? Nvidia may have to cancel billions in China orders, according to the Wall Street Journal. Wow, I guess that's why the stock spiked down to 390 something early this morning. Whoa.
Bottoming. We heard that from IBM last week. And I do think that we're also hearing wafer fab equipment, the end market, is bottoming. We heard from Lam Research. They actually increased their guidance twice so far. Stock is still down a lot from a year ago. So I do think you're going to be able to pick your spots. I think Broadcom is getting wrapped up in the whole VMware thing. Let that pass. If it doesn't go through, they're going to buy back a ton of stock. If it does go through, 55% of their revenues is going to be recurring. So I think there are opportunities. But you asked at the top of the show if we think that there's a rally into the end of the year. I absolutely do. I actually think the sentiment is really washed out right here. And whether you're looking at the S&P oscillator, whether you're looking at the fear and greed index, you look at Josh's RSI stuff, it's all really pointing to very negative sentiment. And that's number one. Number two, I think the Fed is done, right? Even if they go one or two more times, they're done. They're basically done. You're in the ninth inning, and we're not going into extra innings because I know you were going to ask me that. Peak rates, I do think that we are seeing peak rates. Look at the bond market, right? Look at GDP and PCE and ECI today, and it's kind of like in a trading range right now. It's not exploding higher, so I think you're starting to see a peak in rates as well. Add it all up, earnings are coming in better than expected. Yeah, 2.5–3% isn't something to get so excited about, but it's certainly better than negative, and that's what people were expecting heading into the quarter.
So what she just said there is very important toward the end. She basically talks about she believes rates are topping or have topped. And, if that can become a view on Wall Street in general, we could definitely have a year-end rally, right? Because rates has been one of the things that have worried everybody, right? What if treasuries keep going higher and money keeps funneling out of the stock market and it goes over there and catches a 5.5% yield? Or what if it starts pushing up to 6%, 7%, right? So that's been the worry, the big worry. Now, if you get off of that worry, right, then people start to say, oh, man, rates have topped. They're going to start going down. I need a position in the market ahead of that because as people's treasuries, let's call it, hit that 6-month mark or the 12-month mark or 3 months or whatever they got their treasury for, right? Then they have to funnel that money back to the market because then they don't want to funnel into treasuries anymore. So, if that could become the view of Wall Street, then we'll definitely have a very nice year-end rally. But you need Wall Street in general to start feeling like that. All right, next one up here. Companies laying off employees is a risk facing 2024 JP Morgan.
Ranked number one in both portfolio strategy and quantitative research this year by Institutional Investor. Inducted into their All-America Hall of Fame list, he is Dubravko Lakos. He's the Chief Global Equity Strategist at JP Morgan. Congratulations.
Thank you.
Good to have you back.
Thanks for having me.
All right, so by virtue of these accolades, your point of view matters to a lot of people. You heard Jim suggest that the economy is doing much better than people think it is. You're one of the doubters, in some respects, about where the economy's going. So let's match this up.
Yeah, absolutely. I am one of the doubters. I've been a doubter even the last time I was here on the set when the market was higher. So for us, macro is really like the big headwind that markets are facing. higher for longer, cost of capital being elevated is something that we've been talking about since February. Liquidity is getting sucked out of the system as well, which I think is generally a pretty big and important headwind. Obviously, there's geopolitics that we can talk about, but that's also an additional tail risk that's very hard to sort of handicap. Fundamentals, to your point, I agree. I think I see them slowing. They're just not collapsing. And the word that I would use on the fundamental side is we're seeing increasing bifurcation on the fundamental side.
It sounds like the crux of your argument is built around the idea that the lag effects are going to be more dramatically felt than people realize today. Fair?
Yes, very fair. I think there's just a lagged effect, and this time around in this cycle, the lag simply may be longer than what we're accustomed to sort of seeing in the prior cycles because of the unprecedented, injection that would go.
Boom. That's a point I've made a lot of times in terms of lags, right? When you come off of what we came off of from the stimulus side, I mean, that was incredible. And, the Fed lags, I've told a lot of you guys this many times before, but the Fed lags take 1 to 3 years to catch up. So basically, minimum of a year from the time the Fed starts raising rates like crazy till it really starts to hit the economy. So obviously, we're going into year 2 in 2024, right? So that's going to be a moment where we should see the Fed lags catch up. If they don't catch up in 24 and it takes all the way to 23, I can make an argument that they're already catching up. So it's more than likely they catch up even more. And that's just going to put the Fed in a situation where they're going to have to consider at least cutting rates in 2024. It's certainly no guarantee that the Federal Reserve is going to cut rates in 2024, but they're going to have to definitely at least consider it. There's no doubt in my mind that they're going to have to at least consider it in 2024. I think it's just a big question of do they cut at some point in 2024 or not? Because, those Fed lags start to catch up, and they start to catch up hard. So, something to keep in mind.
During COVID, and because of a relatively healthy starting point for things like balance sheets.
And by the way, just so everybody's clear, in regards to Fed lags catching up, just because they catch up, it does not mean you're guaranteed hard landing, horrible recession, 10% unemployment, all those sorts of things. Okay, so just do keep that in mind when we talk about the Fed lags catching up.
Jimmy, I want you to respond, and then I want Steph to also, because you guys have a more sanguine view on where we are relative to Davco and some of his colleagues over at JPM.
Okay, Davco, always good to see you. Thank you. Look, for the last year and a half, I think you'll agree, the economy's done a lot better than expected. And let's just chalk that up to the lagged effects being a lot more lagged than any of us expected. All right, let's just say I give you that, and we can disagree about the path going forward. But these companies that during this extremely long lag time have out-earned, and cleaned up their balance sheet, doesn't that actually perversely extend the lag further from the point of view of they have less debt to refinance, right? I mean, that's what we're worried about, at least at the corporate side, is they're going to have to refinance at these much higher rates, except now there's a lot less debt because they've paid down a lot with all the extra cash flow. Is that right?
Yeah, I think that's broadly right, but I think that's just one part of the picture. I think for the S&P 500, for the large cap complex, balance sheets are in a pretty good spot. Rates going higher is a headwind, but just a gradual headwind. The problem is, I think, as you move down the cap spectrum, you look at mid caps, small caps, the entire private sector, there's a more significant portion of that that's variable, that's more sensitive, if you will. Balance sheet is more sensitive to cost of capital. And everything that's happened so far during this, call it increasing headwind from cost of capital, has happened under a relatively healthy top-line demand type scenario, where pricing power has been strong and where a lot of corporates have been basically growing not organically, but just through price.
So before these gentlemen go further here, there definitely is a worry about companies refinancing debt and having to do it at much higher levels, obviously in 2024, 2025, than they had to back in, obviously, 2020 and 2021, right? And some of that debt coming due and what they do with that. And so that's a worry. But I still think, at the end of the day, if you want to worry about something, the biggest worry by far and away is obviously always going to be the consumer. Now, there is a scenario in 2024 where actually the consumer gets in a better spot and a stronger spot in 2024 if inflation can stay at bay and everybody keeps their jobs and let's say get some nice wage increases in 2024 and then real wages spike up and the consumer stays in a great spot and we keep pushing things out. But it really comes down to the consumer. If the consumer keeps out their spending, we're looking pretty dang good. If the consumer ever really pulls back, like a lot of people have been predicting for the last year or so, that's the moment that we really start to have some trouble in the market. Because let's not forget, How are all these companies making all this money? It's the consumer, right? And when the consumer starts to pull back in regards to any of these companies, we see what happens with their stock price. I think Tesla's a good example of that, right? Consumer pulls back, Tesla has to cut price a lot, margins get hit heavy, right? And stock price gets hit heavy.
Forgive me, why aren't companies laying off people?
I think that's the lagged effect. I think that's a risk that we're facing in 2024. I'll give you one statistic. S&P 500, if I'm not mistaken, which is right, the fortress balance sheet employs only, I believe, 12, 13 million people. If you look at mid-cap, small-cap, private sector, you're looking closer to 60, 70 million. And that's the area that's more vulnerable to the macro
headwinds. Small caps are in a bear market already, though. Like, what if a lot of what you're saying is true and priced in?
In all due respect, Mr. Josh Brown, those stocks are cheap, and there could be definitely some priced in, but if you were to talk about some sort of major deterioration in the economy, then obviously earnings will get hit much heavier. Some companies that are making profits could go to making losses. Some companies that are making huge profits could start making small profits. So to push back against that, that's how I would do it.
The Russell is not the S&P.
I think things are definitely getting priced in, but to me, that's a worrying sign. To me, that's a sign that the market is telling you things are slowing down. We're hanging on to the Magnificent 7, Magnificent 11. All the returns this year are coming from basically 7 stocks. So that's telling us. So I think, yeah, we better hope that the Nvidias of the world keep just really rolling in very, very strong numbers. The second that goes, what do you hang on to?
I mean, it was a great point by him there, right? Great point. I'm looking forward to getting in this one. Scariest charts in the financials markets. Ooh, boo, scary. But a phenomenal point toward the end there, right? You know, if you look at the Magnificent 7, Magnificent 11, whatever you want to call it, right? The 7 to 11, like biggest stocks that have helped all the gains in the market, those companies actually employ a very small amount of the workforce, okay? Look at Nvidia's workforce and look at how many Americans have a job, right? Look at Apple, look at Microsoft, look at Google. I mean, these are huge companies, but they're so small in regards to how many employees they actually have hired, essentially, right? Look at Meta. Like, you look at all these big dog companies, they have like hardly any employees compared to what the overall economy is. So, you know, they're not really an accurate representation necessarily of the economy, right? And even if those companies stay strong and they keep their employees, what about all the weaker ones? Because that's where all the job losses come. And small business is always what runs the United States of America. I've always said it since I started my channels in 2016. I always will say it. Small business is doing good. The United States economy is doing good. If small business is starting to get hurt significantly, you need to start to worry, because that's a moment when, you know, things start going bad. Small business always has run the show. Small business is the reason the big business can make so much money. And you got to always keep that in mind, okay? Alrighty, next one up here. Last video to react to, the scariest charts to watch in this stock market right now.
Things are going to get scary now, though. It's Halloween tonight, so it must be time for the annual M&G Investments Bond Vigilantes roundup of the scariest charts in global finance. And when vigilantes tell you something scary, you better listen. Now, one chart that stood out to us was this one, with many companies having put refinancing off for some time now. Maturity walls are closing in.
Ooh, okay. So look at this chart here, folks. Even if you're only listening in to this video, watch this chart right here. Like, look at this, okay? High-yield issuers face headache. Percentage of high-yield bonds maturing in the next 2 years. And so, obviously, we're at the highest numbers we've pretty much been at, interesting, since about 2010. Oh, that's very, very intriguing. Okay.
Of high-yield issuers face refinancing risk in the next 2 years. This has the potential to become the largest refinancing effort for high-yield issuers since the GFC, the great financial crisis, if great is appropriate. Let's talk to Andrew Eve, the author of these charts, investment specialist at M&G Investments, who brings us this horror show this morning. Andrew, thank you very much for joining us. So the percentage of high-yield bonds maturing in the next 2 years does look scary. Does it look scary to you?
It does look scary. I think we've seen now we're something like 18 months into the hiking cycles of most central banks. And one of the things that's been surprising to investors is that high-yield valuations, high-yield credit spreads have remained quite resilient. Some sell off over the past few weeks, but broadly speaking, we've seen high-yield spreads get down to some of the tightest levels that we've seen since the GFC. And yet, despite this, we've got this big maturity wall coming. I think there's a couple of reasons that credit spreads in high yields have remained quite tight. Partly there's demand from yield-hungry investors, and also there's a lack of supply because high-yield issuers, quite sensibly perhaps, have held off from issuing with borrowing costs being so high. But the other side of the coin, of course, is that with many high-yield issuers having held off from issuing bonds, we've now got maturity walls closing in. And I think this could be, as you say, one of the perhaps largest refinancing efforts for high-yield companies since the GFC.
Okay.
So a conspiracy theorist would say this is proof that the Federal Reserve will start to lower rates and lower rates substantially within the next 24 months. And the reason being is so all these companies can refinance at much lower rates than where we're at right now, okay? That's what a conspiracy theorist would say, and I think he'll probably be right, to be honest.
Congratulations on getting Anna into the Halloween spirit.
I know.
Kicking and screaming.
Absolutely. Dragged, I was.
Andrew, that's an image there for everyone. Andrew, as we meditate on the fact that Anna was hauling pumpkins around last night across North London.
Oh, well.
Andrew, in terms of the high yield risks, then, is there a region where those risks are more acute than others? Is Europe at the forefront when you're thinking about the risks around high yield? Is it Asia, US? How does it stack up on a regional basis?
I think it tends to be that the US is the riskier element of the high yield complex. European issuers tend to be a little bit more defensive.
Oh, how dare you say the US is the problem, sir? That's utterly ridiculous. I can't believe you would even say something like that. Frustrates me, really.
In terms of the sectors that we tend to see issuing within Europe. I think one of the silver linings that we see within high yield, despite that very scary chart with around 10% of high yield issuers needing to refinance, is that if you look below the numbers there, that 10% is made up largely of the double B issuers. So right at the top of the high yield complex, the most creditworthy companies who not only have more resilient fundamentals generally, but also perhaps face more benign refinancing costs.
Fallen angels. Sounds a bit Halloween-y, doesn't it? Let me ask you about inflation then. And you've got another scary chart for us. Let's move on to this one. Inflation, usually you say, comes in waves.
Oh my goodness, does he just carry around scary charts all over the place? Come on, it's utterly ridiculous.
And you've got a nice sort of offset of what inflation has looked like recently, and you compare it back to, drum roll, the 1970s, as many people do. But does it usually repeat? Does history repeat in the way that your chart perhaps hints it might do?
Well, I think that's right. Financial markets do tend to repeat themselves. History does often repeat, and I think we should look at what's happened when we're trying to think about what happens today. Now, inflation has been falling. Price pressures are clearly easing. We've seen monetary policy start to tighten, and the effect of that is coming through into the economy. But this chart really shows us that maybe we should treat that with caution. Inflation does tend to come in.
Alrighty, folks, here's the next scary chart, folks, okay? So this one, sharks lurking beneath inflationary wave. Ooh, inflation usually comes in waves. So basically saying inflation's going to go down, continue to go down here for the next, we can call it 6 to 12 months. Then it's going to spike higher like it did in the 1970s. Is it possible? Sure, it's possible, okay? Is it super likely? It is if the economy really held up super strong and when the Fed lags never catch up with us over the next few years. But I can tell you, the United States is so competitive nowadays when it comes to business that when times get hard, we actually can go into deflation. We saw this certainly in the Great Financial Crisis. And it's because businesses have to start competing super hard against each other. Prices could actually go negative, right? Everybody's doing sales, discounts, and things like that. So I think that's something that should be factored in. Also, back in the 70s, you had a baby boomer generation, right, that was coming of age and was entering the workforce during the 1970s for the most part, right? Huge baby boomer generation all entering the workforce, so that helped keep inflation a little higher. There was a lot of household formation during the 1970s, and so those are all factors that came into play, I think, in a major way in the 1970s, in why you had a Federal Reserve who didn't go hard enough the first time, right? And so that's why inflation came back later on, a year or two later. So it's always a possibility, but it's not as likely as I think many folks might be expecting or something like that. The economy is so much different today than it was in the 1970s. The companies are so much different. The employee force is so much different. I mean, everything is so much different than the 1970s versus now. It's hard to even compare back to that time period.
It does tend to come in waves.
I mean, at this point, it's almost like comparing back to the Dark Ages, to be honest. It's just, there's been so much changed over the past 50 plus years.
And I think that makes sense because inflation tends to cause problems in the economy, problems for people, and that's, of course, what we're seeing at the moment. And governments naturally then try to solve those problems. And the way they do that naturally is to spend. I think we're in a political climate where there's not much appetite to increase taxation, and therefore with a need to spend to solve some of these problems, presumably the only way is to issue debt. That's
a fair point. I can't argue against that, sir. No way.
Come in and buy that. We could see money supply, which has fallen over the past couple of years as central banks have tightened rates, start to increase again. And maybe we will see a return of inflation in the more medium to long term.
Well, that brings us to financial conditions then. You've got a chart that also talks about the fact that real rates are back in positive territory.
Oh, hold on. We got a new chart here, folks. New chart. Okay. Here's the new chart, folks. Everybody got this one? Check this one out. Real rates back into positively scary territory. Fed, I guess this man just carries scary charts around everywhere he goes. Fed rate minus core PCE. Oh, okay. Fed rate plus core PCE, 3-month annualized. And so right now we're at almost, well, let's see. So we're getting close to a 4% number there. So I guess he's making the argument that it's going higher. I don't know. This is a weird chart. I'd love to hear him talk about this
conditions then. You've got a chart that also talks about the fact that real rates are back in positive territory and the consequences for that if that becomes a theme longer term. The central banks talk about higher for longer. Talk to us about the potential implications as markets adjust to that new reality.
As you say, markets are adjusting to that new reality, and we have seen central banks now manage to get conditions a lot tighter. We know that monetary policy tends to act with a lag, usually 12 to 18 months. And while central banks have been tightening for some time, it's only around now that perhaps we're beginning to see the full effects of that coming through into the economy. Now, what that scary chart shows is real rates. So we've calculated that there as the Fed funds rate minus core PCE, so the Fed's favoured inflation measure. And if we look through history, what we tend to see is when that measure gets above around 3%, that tends to be a precursor to recessions. Financial conditions are then sufficiently tight to start slowing the economy. And if we look at the charts now, what we see is, based on the annualized data, the real rate having
That's interesting. And also yield curve inversion should, in terms of when it actually hits, in terms of when it hits the economy, it should be 2024 based upon when the yield curve inverted versus how long it usually takes. So it should hit in 2024.
2%. But if we look at the 3-month PCE annualized, so more recent inflation dynamics, we see that actually we've got to above 3%. So a very scary chart for financial conditions.
Interesting. So I appreciate his thoughts there. I got nothing more to share. I need to hurry up, release this video, and then I need to hop on Twitch for today's live stream, react to those AMD earnings / market trading. It's going to be crazy. Tomorrow's PayPal, next day's Apple, absolute craziness. Appreciate everybody being here. As always, new all-time high subscribers in the history of the channel. I appreciate every single person subscribed here. Much love as always. Join me on Twitch. Just pin comment down there, and have a great day.